Well, the market itself has been doing rather well, but there have been a lot of uncertainty thrown into it because of the election. And just as we were instituting a lot of the final regulations of Dodd-Frank, the Trump administration came in and said, we're going to get rid of all of it. And so, some businesses thrive on uncertainty, but finance in commercial real estate really likes the predictability. So we were just getting used to this, but it's probably going to open up some avenues for particularly unregulated firms. And it may mean that some of the companies that got out of the CMBS business recently might actually get back in. And that will make for more capital availability. And that's not a bad thing for the commercial real estate market. It'll help prop out values, but it can also exacerbate the real estate cycle. So it's hard to say what this new capital might do once it gets into the market. Dodd-Frank was honestly starting to be welcomed by the largest CMBS lenders in the market. Those were usually the bulge bracket banks. And because they're the ones that had the sophistication and the money and the resources to comply with all the regulations, most particularly risk retention. So Wells Fargo as an example, has the capital to invest in their own bonds. Many of the other conduit lenders that were out there couldn't. So some of the big banks have actually seen this as an opportunity to increase their market share at the expense of smaller competitors. So the repeal of that may actually bring some of those smaller competitors back into the market. I don't think that will necessarily lower spreads for borrowers, but it may make capital more available for more aggressive, for borrowers that require a more aggressive loan. The big difficulty with commercial mortgage-backed securities today is hedging. When the market dislocated in 2008, all of the hedging strategies that we'd used on Wall Street failed. And there is really no good, inexpensive hedge for a long position in CMBS because nobody wants to take the opposite side of the trade. And what that's done is that it's caused a lot of different attitudes within the market. And some banks have said, we don't like the volatility of the profit margins that we had in CMBS lending now that we can't hedge well, and so we're going to back away. And we're going to go into more portfolio lending where those instruments don't need to be marked to market on a daily basis. Some of the other firms have said, we're okay with the volatility, our profits are good enough, or they're just more aggressive, or maybe they're more sophisticated at hedging. It's hard to tell from my vantage point, but those firms have said we'll go out and originate loans. So a lot of it depends on the management philosophy of the company. There are technical difficulties, as I said, in hedging. There are also technical difficulties in the fact that so much of CMBS is paid down that it is no longer as large a component in the Barclays fixed income index as it used to be, and many of the buyers out there try to track that index. And so if it's not it's a vicious cycle downward. If it's not a big part of the index, they won't invest in it, and there's less demand for the product. I think now that underwriting has gotten more conservative, I think the CMBS market has actually rallied, and spreads have come in quite significantly over the last, say, 6 months. And I think that's leading to more competitive pricing on the part of conduit lenders, which is ultimately a good thing for the market. I think risk retention is probably needs to go if the CMBS market is going to recover to some level closer to what it did in its heyday. The risk retention simply puts a barrier to entry to new competitors in the market that want to lend, and also puts a cap on the lending that even the biggest players can make, because it's rare that you would be asked to take a bond and then are forced to hold it for 10 years and you You can't hedge it. You can't, you can't sell it. You can't shift risk in any way, shape, or form. And even portfolio lenders that make portfolio loans can sell those loans. So in many respects, the regulators have made risk retention bonds more illiquid than even the whole loans that CMBS was meant to liquefy originally. And that's not a good thing for the market. I think I'm not the biggest fan of complete deregulation, but that's one element that probably needs to go if CMBS is going to make a comeback. CMBS is very susceptible to general capital flows across the economy. It's not as liquid as it used to be, but it's still very liquid. A AAA CMBS can trade very quickly at not as tight a bid-ask spread as it used to be able to be traded at, but it can still be traded very, very quickly. And that means that capital can flow in and out of the CMBS market very rapidly. And that's always made for a bit more volatility. I think, again, the inability to hedge has actually increased volatility because you simply can't dampen the trade that you can't dampen the volatility at all by using a short. And so I think capital flows are one big issue. I think people still haven't learned to trust the asset class after the high levels of delinquencies from CMBS 1.0, which were really loans made from 1998, say, to 2007. I've seen the loans up close, and they are lower leverage than they used to be. There's no pro forma underwriting. The property quality is probably about the same, maybe a little bit worse than it was. But ultimately, they're better loans than they used to be. And the market hasn't gotten used to that. I think the other thing that's causing problems is that it used to be that you could lever up these bonds quite significantly, and hedge funds played in the CMBS market to a great extent in the first go-around back in 2005 through 7. But that leverage is now not available, and the hedge funds the fast money buyers are really out of the market now. And so that means that the big AAA buyers are life companies, buy and hold, and pension funds. Hedge funds, I'm not close to the trading the way I used to be, but hedge funds as a class of investor are much, much lower as a percentage of the trading than they used to be. I think the other problem is that with CMBS is that the Basel III accords have forced trading shops, the big trading shops, to hold more capital against the bonds that they hold in inventory for market making, and that has dramatically decreased their ability to make markets in the bonds that oftentimes that they originated. And so that has also decreased liquidity in the market. So for the CMBS market to really come back the way it used to be, you need to attract new buyers, you need to get rid of some of these capital requirements for secondary market making and the Volcker rule, and you need to get rid of risk retention. And I think the buyers that are out there need to feel that the underwriters are underwriting good loans, and unfortunately only time will tell that, and to see how resistant these new loans are to a downturn in the economy. Those 10-year, the big wall of maturities is probably going to go out with a whimper and not a bang. I think that there are some loans that are going to need to be restructured because they didn't have enough amortization in them, and they didn't. Their underwriting was pretty aggressive when they were first made. But most of those loans, probably well over 70%, are going to be paid off at par on their maturity date. The tricky part will be in 2018. In 2008, there were no loans made in the CMBS market, and so you wonder what the the absence of maturities will be in 2018 for volume. The CMBS market will have to take loans away from banks and life insurance companies in 2018 to fulfill their volume targets. They're not going to be able to do it on refinancing 10-year loans that were made in 2008. There's just not enough of them. Loan restructurings are highly dependent on who the lender is and the economic times that that lender finds themselves in. So as an example, portfolio lenders might feel there's internal politics in a loan restructure or a workout. That politics is non-existent in the CMBS market. It has to be by contract a pure economic decision. So, in my old life company days, there were loans made that the executive officers just wanted to sweep under the table. They wanted to hide the loan as best they could because they were embarrassed that they ever made it. In the CMBS market, that's not the case. It's a purely economic decision made by the servicer and the subordinate bond buyer. And so what you'll find, for instance, is when the market was falling in value, when the market prices for real estate were falling in value, the CMBS lenders often held those loans in the trust, either as an REO or as a defaulted loan, much longer because they were waiting for better times to come. So the workout strategy was often to buy time and wait for the market to get better. As the market improved, the tactics changed. And again, they're making purely economic decisions. So what they want to do is to get rid of that loan quickly into a rising market, and as a way of making sure that nothing bad is going to happen around the corner. So if the market's getting better, let's foreclose on the REO or on the loan, take the REO and sell it as quickly as possible. And that's really what's happening now in workouts and foreclosures. There's really not that many workouts and foreclosures in loans made post-2010. But the loans that were made prior to that are getting, there's really not many workouts being done. They're mostly foreclosures. So the borrower has to come in with a lot of new cash and add value to the property and to the loan in order to get the attention of the lender. And even sometimes in those circumstances, they don't want to cut the deals. So they'll just foreclose and sell the REO as a way of maximizing the net present value of what's left of the loan. It started because Merrill Lynch as a company was failing. They were being taken over by Bank of America, who had already bought two other conduits, CMBS lenders. So they combined 4 conduits in about a year and a half into one, and they went from 400 plus employees to 65. So we started our company because we were not going to be offered jobs at Bank of America. And we decided, let's throw our hat in the ring and see what we can do. And I think our company is one of the few that still survives today and actually is thriving today. So we're very proud of that. It's been a long haul, but it started because we were told to leave. And we started our business because we were going to be the best company to hire ourselves out in the market at that point. And a lot of sweat equity went into the business, but it's come out very well. I'm actually very grateful that I was laid off at that point. It turned out to be a tremendous opportunity for us. I was a townie growing up. My father taught at the College of Human Ecology in the 60s, and I grew up as a little kid in Ithaca, and never even had to lock our doors when we went away for the weekend. It was that safe a city to grow up in. And I always wanted to come back, and got the opportunity when I applied to business school here. And I think, well, first of all, I'm amazed at the changes that have happened over the last 20 some odd years since I was here. And it's been a tremendous achievement on the part of Cornell to see the growth of the program, of the business school and the Baker program. I don't think they let me in today. I really don't. I think when you look at the students that they're attracting from all over the world, it's impressive. And as an alum, gratifying. It's good to see the alumni network growing the way it has. But I think, like any program, you get a stamp of approval by being here at Cornell that's hard to find anywhere else. And that enabled me to compete for jobs at my first job at a life company, Prudential Insurance, and then later on Wall Street, in a way that a lot of other schools could not have done for me. But it helped teach me how to think, especially teach me how to think as a financier. The finance classes were excellent. I even took a law school class, pass-fail. I was not a lawyer, but I passed. And I think the interdisciplinary environment here was apparent even when I was in business school. I was able to take a mixed-use development class at the hotel school. And there are very few business schools that could have offered me that kind of just cross-pollination of knowledge. So I think that's a great strength of Cornell, that I think it's really used to a T with the Baker program. I mean, you take courses all over the architect school and the law school and the business school and the hotel school. That's an unusual event in higher education, I think, and one that really suits the program beautifully. So it's got a great alumni network, and I think, but it really did impart the kind of finance and accounting that I needed in my first couple of jobs out of school. And then after that, it's really, what have you done yourself, right? What have you done for them lately or for yourself lately? It's after about 5 or so years, your MBA becomes a little bit less important, and what you've done in your career to that point becomes more important. But there are still economic concepts that I use almost on a daily basis that were taught to me both at my undergraduate university and here at Cornell. Valuation has not been much of a problem recently. I think it has been for B and C quality malls, and that's in the middle of a very vicious downward spiral right now. When lenders will not lend because they're concerned about the future of that property, the property automatically falls in value because now you can't lever your return. So that's a very difficult place to be right now. But most of the other property types are actually doing all right. I mean, you can argue whether some of them are in the 8th or 9th inning of the ball game, but industrial is going through some interesting shifts with the growth of Amazon and 1 and 2 and 3 hour delivery, where you need warehouses right near big cities to deliver your goods quickly. That's a big change. The internet's causing a big change there. And I think, but the deal flow, to answer your core question, I think, is still one of how do you maximize leverage at the lowest price? That's always really the case in the financing business. And where can you find inexpensive equity? Where can you find inexpensive debt? And lots of it. And I think right now you're seeing, because of the regulations of particularly risk retention, you're seeing a lot of companies, non-regulated companies, jumping into the lending space and becoming lenders themselves, private lenders. They're not regulated, they're not required to hold the assets, even though they're structured to hold the assets. And that allows them to be more nimble, possibly lend more at a higher price against the property. So very quickly, you're seeing that private capital formation has become much, much more efficient over the last 25 years. And the mechanisms are in place for Blackstone to deploy billions of dollars worth of capital very, very rapidly. And before those big guys came along, it was a much more difficult aspect to go out and find those dollars. But now you're seeing a lot of entrepreneurs start with $100 or $200 million, and they're making loans with that money. So they're filling some of a void, particularly on the construction lending side, that banks, the HVCRE rules that have been promulgated are cutting back on the amount that construction lenders can lend, and it's also making them more bureaucratic and more in their underwriting. So because they've got more regulations that they've got to live up to and comply with. So that's also a place where private capital has jumped in and can be much more agile. And we've seen some companies put out billions of dollars. I think a core real estate last year put out over $5 billion. And they're former, not colleagues, but I've worked with them in the industry, and they're very smart, very capable, and they've gotten private money behind them, and they're very agile. So they're like the poster child of what you can do in the private equity side of things.